Hey everyone, and welcome back to the channel. Today we are talking about something big, like global financial shock kind of big. You have probably seen the headlines: $1.7 trillion gone overnight. Wall Street wiped out by $5 trillion in just 3 weeks. The dollar slipping, US bonds dumped, and surprisingly, Japan is right at the center of it. Now, I know what you're thinking. Wait, Japan? USA trusted ally for over 70 years? Yes, and not just any move. This was a silent but devastating financial strike. So let me explain how it all unfolded. For decades, Japan was quietly one of the biggest supporters of the US financial system. It held trillions of dollars in US treasury bonds that meant America could borrow cheaply. The dollar remained strong, markets stayed stable. But then, one night, Tokyo flipped the script. $1.7 trillion in the US treasuries dumped, just like that. USA bond yields skyrocketed, the dollar dropped, and the stock market tanked. Wall Street lost over $5 trillion in value. Yes, you heard that right. Trillion with a T. To investors, it looked like a panic sell off, but from Japan's point of view, it was just retaliation. So, why did Japan, a long-time US ally, make such a drastic move? Well, came down to tariff. The US administration imposed sweeping tariffs targeting electric vehicles, and that included Japanese giants like Toyota, Nissan, and Honda. These were not just businesses, these are icons of Japan's economy. But instead of negotiation, the US lumped them together with so called foreign threats. No warning, no talks, just tariff. And that was the trigger. Japan responded, not with words, but with dollars, or rather by ditching them. So here is where it gets scary. What started as a financial move quickly hit real people. Car prices surged, imported EVs gone. Inflation came roaring back. And as the dollar fell, everything Americans import, from gas to groceries, electronics to essentials, started to cost more. Suddenly, the same middle class that was promised protection from foreign imports was now paying the price. Mortgages became more expensive, savings lost value, retirement accounts took a hit, and everyday people, they were blindsided. And here is the part that's hardest to digest. This did not happen by accident. This was a result of short sighted economic strategy, prioritizing political wins over long term financial stability. But Japan wasn't acting alone. Its decision to dump treasuries and shift capital sent a signal to the rest of the world. We no longer see the dollar as the only option. And other nations took note. China accelerated its de dollarization, boosting yuan based rate. Russia, already out of the dollar game. And then came India, South Korea, Brazil, UAE. All started exploring alternative reserve currencies, expanding currency swap mechanisms, and diversifying reserves. Japan took it a step further. It started redirecting capital into Asia and started buying regional bonds, building deeper currency cooperation, pushing for fewer US dollar transactions, and just like that, a new financial order began forming, with Asia at the core and the US dollar on the sidelines. Now you might ask, how did the US not see this coming? Simple: overconfidence. Washington assumed Japan would never retaliate. They believed the post World War II alliances, the US military presence, and decades of cooperation would keep Japan loyal. But this wasn't about loyalty, it was about economic survival. And when pushed too far, even your closest partners can walk away. So, where does that leave us? Today, US financial markets are shaken, global investors are questioning the dollar's dominance, countries from Asia to Europe are exploring new alliances, new currencies, and new rules. And rest of the world is asking one crucial question: is it time to step out of the dollar's shadow? So now coming back to the main question, how could this impact India? Volatility in Indian equities would increase. The US markets influence global investor sentiment, and when Wall Street sneezes, the Wall Street often catches a cold. So expect increased FII outflows from Indian markets in the short term, especially from large caps and sectors linked to exports. Rupee will be under pressure, and a weaker rupee may hurt import heavy sectors like oil, gas, autos, and electronics. Bond yields and RBI response could surge global interest rate, expecting shift. For India, foreign capital might flow towards higher yield US treasuries again once panic settles. The RBI may need to adjust rates cautiously to balance inflation with growth. Indian debt markets and rate sensitive stocks, banks, NBFCs, and real estate could feel the heat. Alright, so let's see sector wise impact on Indian stock market. Let's begin with IT and software. Could be negative, but the US clients might cut discretionary spending, hurting revenues. FMCG and healthcare could be positive. Defensive sectors may see inflows during volatility. Automobile, it could be a mixed reaction. EV momentum may slow globally, but demand for affordable vehicles in India may rise. Metals and oils could be volatile because it depends on global commodity prices and currency movements. Banking and NBFCs could be mixed. High bond yields might impact treasury earnings, and we need to watch credit demand. Alright, a long term shift that India can benefit from de-dollarization. So while short term market volatility is likely, India could benefit strategically from the large trend. So we could see rise of regional trade blocs. Japan, China, South Korea, and Asian nations are pushing for regional bond markets and currency swap arrangements. The shift away from the dollar could encourage INR based trade and can strengthen India's role in alternative financial frameworks like BRICS or SCO. It can further enhance resilience of India's domestic demand. So, unlike export dependent economies, India has a strong domestic growth story. Sectors like FMCG, infra, healthcare, and renewable energy continue to show promise regardless of global headwinds. It could lead to boost to local manufacturing as global supply chains diversify and nations reduce global dependency. India's Make in India and PLI schemes became even more attractive. So, what should Indian investors do now? Diversify across asset classes. Consider adding bond ETFs, gold ETFs, and defensive stocks to hedge risk. Stick to quality stocks. Focus on companies with strong fundamentals, low debt, and consistent cash flows. And more importantly, stay calm and invest long term. Markets stay choppy for a few weeks or months, but India's structural growth story remains intact. Always track global cues. Keep an eye on US inflation, bond yields, and RBI policy statements. Global sentiment will drive flows. Alright, final thought. Is it India's moment to shine? Yes, Japan's bond dump has shaken the financial order. Yes, the dollar is under pressure. But in the middle of the chaos, India stands on relatively solid ground. With volatility is inevitable, this global realignment also presents a unique opportunity for India to increase its influence in global finance, becoming a bigger manufacturing hub and attracting a long-term investors can see growth with stability. So stay alert, stay invested, and don't let panic drive your portfolio. And if you like the video, don't forget to hit that subscribe button and tap the bell icon too. That way, you will always know when I drop something new. So let's keep learning and growing together.